It is value after hours. It's 10:30 a.m. on the West Coast, 1:30 p.m. on the East Coast. No idea what it is, Australian Eastern Standard Time. I think it's really, really early. I think it's like 3:30 a.m. Bill is out today, and so it's only going to be Jake and I. What's happening, buddy?
Super concentrated portfolio today.
I don't recommend this level of concentration.
Yeah, it's dangerous. It's how you take a zero. Yeah, unfortunately, we had a couple fill-ins lined up as backup hosts, and then had some late scratches in the lineup. So you guys are stuck with two.
Ian isn't feeling well, so will rejoin us at some point in the future. Yeah. So the big news. So the second comment here after Kathmandu. I know there's a few. Sorry, I missed a few early ones up the top there. Alibaba and Charlie Munger, his ongoing love affair with that stock, or what? So what he's done is he's doubled down twice as it's tanked, and I think it got down as low as 75, and then he has, I think that was close to his last, because where he might have bought it again, and then it's bounced. It's like $110 or something, and he's chopped the stake in half. What do you make of that?
Yeah, hard to say. Like, what's all this? What happened to never sell? Or maybe he felt like maybe the world changed and he changed his opinion a little bit. I mean, there's definitely some risk has come to light a little bit as far as geopolitics in the last few months. So maybe he reassessed a little. I don't know.
Do you think that was not obvious beforehand?
I don't know. Maybe he was surprised by how much sanctioning that the US did, and that then therefore like that added another layer of risk that, maybe the world would more likely to decouple a little bit. I don't know. I mean, lots of different, who knows what goes on in the mind of a genius.
Yeah, it feels like, it looks like the way that someone who's just come into the market trades, though, doesn't it? Like just to double down a couple of times, and then when you get the little bounce, to like,
I just got to get back to break even, and then I could sell.
Break even, get rid of the margin.
I hope we'll find out in a couple of weeks at Berkshire, and then
someone's going to ask the question.
Someone's going to ask for sure.
He's not going to say this is a Berkshire meeting. Those questions you can direct to me at the DJ Co meeting.
No, I bet he'll answer it. I think he'll.
Because he seemed very unwilling at that Daily Journal meeting. He was just like, he gave the answer that everybody who had a gigantic position in a company and ran a company would like to just say to everybody else, like, just don't worry about it. We've got it under control.
Yeah.
But they were fairly reasonable questions, I thought. It's a very big stake. You're using margin.
How about this? What if there was something internal investment possibility within Daily Journal that he thought was a better risk reward scenario? Like, there are other capital allocation decisions to be made there. So maybe he saw the chance to push some money in on the business side and decided that was better use of funds.
I think you're being very kind.
Yeah. Well, I'm not gonna throw Charlie under the bus.
On the other side of that transaction, so my topic for today is going to be the Buffett acquisition of Allegheny, or the Berkshire acquisition of Allegheny. The narrative about the way that those deals come about is published with the SEC, or it's part of the filings with the SEC. And Business Insider grabbed the filing and has kind of written up the way that came about, and you can see how Buffett negotiates. I just thought it was an interesting. I don't think that anybody's going to learn anything new. It's just the way that Buffett negotiates, but it's good. I think for your own purposes, for your own negotiations, it's just interesting to see how he does it.
I was never aware of that filing idiosyncrasy of having to explain the narrative before. I've never seen that.
Yeah, I go and look at them occasionally to see what happens. They're all very vanilla. There's nothing particularly interesting in them, but it describes how they meet, what happens, what they discuss to some extent, and then the outcome of the
Like, how well documented is it? Is it like at this date, we had a meeting and these people were present and.
Yeah, there is a lot of that in there. You must have to take notes as it goes along. I don't know what purpose it serves. If there's a corporate advisory M&A attorney on, let us know what's happening there.
Yeah, is it like antitrust potentially, or like a fair process was followed to
full
acquire?
Disclosure process? Yeah, probably I would say.
Not like a sweetheart deal, or I don't know.
The other thing is the inflation. Yeah, inflation is going absolute bananas. I saw one thing this morning that said Gundlach, Eric Balchunas, who's at the ETF conference, tweeted this out, and he said that Gundlach said this, that if we calculated inflation the same way we did under Carter, inflation is now higher than it was under Carter. And that was always the story, right? That was how Carter lost the presidency, was that inflation was running so high.
Like, what would the number be then? Like north of 10?
16.
Holy. 16. Well, I mean, does that have to do a lot with house prices? Is that the big component that's driving
energy and house prices? Yeah.
Well, you don't need those.
Yeah. the house price, when you dig into it, the house pricing number was like 4.4% year on year, which to me, like, that seems game down a lot.
Yeah.
Like, I don't think 4.4%. That's pretty standard, isn't it? Like, it looks more like when I look at some of the luxury, Fred has some data series, and one of them is LA luxury real estate, which I track for a variety of reasons. But one of them is like
teasing yourself, or what?
The definition of luxury is,
it's not as luxurious as
that's right.
The middle of the country.
Livable, maybe, but what they say is that, I mean, I've been looking at that. It's been running at like 20% year on year for a few months, maybe a year now. Each monthly update is like a 20% year on year. So I don't know where they're getting 4%. I guess this area is, maybe these places run up more, but 4.4% seems like a big miss to me.
Yeah, that's quite a discrepancy from 20%.
What's your topic?
I have a topic prepared on National Cash Register, which is an old company from way back in the day that.
What do they do?
Yeah. Well, now they do like point of sale stuff, but at one point they had a 95% market share on actual physical cash registers that retailers would use for conducting business. And there's a bunch of good, like, this is from a 1906 annual report from NCR that actually Buffett and Munger referenced in like 1998 annual meeting. Buffett said he had it at the office, and he thought it was a good report. But yeah, we can get into that. Let's do yours first. Let's go through the Allegheny acquisition and notes that came out of that.
All right. So this is let me just pull it up. It was a $12 billion deal, and Buffett did it in about 2 weeks. So Buffett had dinner with the CEO, Joe Brandon, and the significance of that is that he used to work as, that's right, he used to work as, he was CEO of General Re. And so he's been sending a copy of his annual letter to his old boss, and they've caught up for lunch, for dinner rather, and that was March 7th. So that's like just over a month ago, and Buffett's wasted little time giving him the bid. It's $850, and then he said, of course, it's not subject to financing or geopolitical risk, and Berkshire won't do any due diligence. Which is always music to the ears of an insurer.
Yeah.
But he said if they hire a financial advisor, the fee gets subtracted from his offer, and the deal is contingent on both sides moving quickly to craft and close an agreement. So Brandon has to go back to the chairman of Allegheny, Jeff Kirby, and then Kirby and Brandon go to meet Buffett in Omaha. And Kirby, who's the chairman, presses Buffett on the price. He says he wants him to raise the price. He doesn't want him to deduct the financial advisor's fee. And he wants him to pay partly in Berkshire stock. And Buffett, and this is quoting from the article, Buffett reiterated the terms of his original offer, indicating firmly he did not intend to change his position on those points.
Never split the middle, huh?
So you can imagine what was said there. So Allegheny goes on to engage Goldman Sachs. It cost them $27 million, which if you spread that over, the bid price reduces it to $848.02 in cash per share,
Instead
which was the final bid. And March 20, they announced the deal 14 days after Buffett made the offer. Allegheny decides against seeking out alternative offers before signing the deal because they know that Buffett doesn't like auctions, and they thought he might pull the offer, and there was the risk of the deal leaking.
I thought there was an open bid period.
So there was a go shop that came after the close. Sorry, after the they agreed to it, not after the close.
Gotcha.
Gave them 25 days to find a superior offer. Goldman contacted 31 potential bidders.
Crickets.
And you know how that goes. I thought that was kind of interesting.
I heard Bloomstrand say that he thought that Joe Brandon might be a nice like bench for Ajit, like a backup in case, a little redundancy in the, next of taking over if, when Ajit is done, which that might have been a good kind of acqui-hire in that way.
How old's Ajit?
I think Ajit's in his 60s. I don't know. I'm sure the hive mind will chive in with the right answer. That's spring chicken. You're just getting started.
Decades to go.
Just getting started. For sure.
Yeah, I thought that was an interesting negotiation. I like the fact that, and we know that Buffett prefers cash. Buffett prefers he doesn't like auctions. He doesn't really negotiate it. I just like the fact that the bid price, $850 is a nice round number, $848.02. That's just like I told you.
Yeah, that's really telling the Allegheny shareholders, like, hey, your management team cost you $2 because they wanted to to get this advice.
I guess you've got to go and do some market analysis to make sure that there's nobody else out there who'd bid.
Yeah, there's a little box checking for the board of Allegheny, right?
That's a modest sort of $2 to find out if there's another $10 out there.
Yeah.
Or $50, who knows?
Yeah.
I mean, I would think that if you were competing against Buffett, and you know that he doesn't raise his bid, and you know that Jane is 70 according to this.
Okay.
He's only got a couple of decades left in that case.
Yep, only about 30 years left on that guy's odometer.
Sorry, I lost my train of thought. What was I saying then?
I don't know.
No one knows.
Well,
if you're competing against Buffett, that's what I was saying. If you're competing against Buffett, he's a good investor. You know that he knows these businesses, and if he's bidding for it, you know that he likes it, that it's good, and you know that he won't raise his price. So why not just come in at $855?
Well, you could make the argument that it's actually worth more to Berkshire than other insurance companies because they're so well capitalized that now a lot of that statutory capital that's tied up at Allegheny could probably be rotated into something else other than, 1% yielding, although rising rapidly, bond portfolio. So, Buffett could take it and maybe put it to better use potentially. And then therefore that equity of the float or the value of that float then becomes probably quite a bit worth more at that point. And maybe no one else could really do that.
That's a fair point. That's in insurance specifically, and in this one specifically, but he bids in other stuff too. Why not just gazump him? I think that people have done that many times before, but that's what I'd be. If I was like Colbert Kravis or someone like that, I'd just be swimming along behind the great white shark waiting for him to make those bids and then just slide in for a couple of dollars more.
Well, that's sort of what people are doing when they hear that, Buffett bought HP and then they go buy it right away for a little bit more than he probably did, right? That's sort of, they're doing that effectively.
I think in this market, you can just wait a little bit and buy it
for less than
but I'm sure. But like that's not a bad approach. Like Buffett's investment universe is very constrained.
Yeah.
So I guess you're buying real mega caps when you're doing that.
Why not just
not that HPQ is a mega cap at whatever it was, 14 billion or something.
Why not just buy Berkshire and go do something else with your life?
That does make it sound a lot easier. Yeah.
Let him worry about it.
Don't have to pay that fee. Don't have to pay that $100,000.
Yeah, $100,000
fee for him to management.
He's chiseling you with.
Dude, hit us with questions today because we're JT and I aren't used to talking for half the time. So
no, this is going to be a lot of tap dancing from the two of us.
Is that time? So we're 15 minutes in. Good.
Yeah, time to shut it down.
Well, let's
do. You know, I'm sure the Allegheny shareholders would have preferred some kind of stock and cash bid to help shield themselves for some taxes, but Buffett wasn't forthcoming with the equity offer of Berkshire shares. Probably not surprising, right? If he was buying back, last quarter,
yeah, he's not going to be issuing stock. He
ain't going to be issuing to you at that point, right? So,
what was the shoe? Was it brown shoes or what was the shoe? That's a really uninspiring.
They were Dexter shoes.
Dexter.
Yeah, they were brown later.
that was a all stock deal, wasn't it?
Yeah.
Those shareholders are just. I mean, I imagine if you'd swapped out your shoe holding for Berkshire shares.
Yeah, that was. I mean, Buffett knows the answer to what that cost everyone, and he brings it up sometimes, but like it's an ever inflating number of what that cost.
Oh, that's rough.
Well, you got to rub your nose in your mistakes. That way you make less of them, hopefully.
Yeah. Let's do your topic and then we'll pad out the other half hour.
Okay. So this is National Cash Register, which fascinating history of this company. And this came from my friend Adam Mead, who wrote the terrific comprehensive Berkshire financial compendium. I forget the exact title of the book. I apologize, Adam, but it's basically the complete financial history of Berkshire Hathaway, I think it's called. And he has a friend, this guy named Jesse, that's on YouTube, who saw Buffett talking in the 98 shareholders meeting, and Buffett and Munger are talking about NCR and this report, and Munger's saying like, God, you could have read that in 1906 and it would have just been blindingly obvious that this was a good situation to get involved with. Like, it's an absolute layup. And
in fact, I did.
Yeah, and in fact, I was long to the gills in it.
He doubled down twice and then he cut the position in half when it bounced back.
Yeah, later. So Jesse on YouTube, he went and was like, okay, like if these guys like this so much, let me see if I could track it down. And like he couldn't find it. No one had it. And he asked around all over the place. I think actually got in touch with Sean Iddings, who's friends with Ian in writing The Intelligent Fanatics. And they have a chapter in one of their books about NCR and John Patterson, who was the CEO. So this guy, Jesse, eventually tracks down, calling all these different libraries and all over the place. And I think it cost him a couple $100 to get a PDF recreation of it that he's now shared with everybody. And Adam sent this over. And so I read through it, and it's a great read. It says it's like 72 pages, but it's really more like 35 because the last, half of it is just listing of people who work at the company, basically. But I want to hit some of the highlights of this shareholders meeting, or the shareholder annual report from 1906. So it's founded, first of all, like the company already existed, and this guy John Patterson, who was he was operating a general store in this little coal mining town in the 1880s, and he talks about like he had $3,000 worth of capital tied up in his general store, and they had great margins, and yet somehow at the end of the day there was like no profit in this business. Like, what the hell is going on here? Like, where's the money going? And it just turns out like when you're running without like a cash register, like you just have leakage, like whether it's on purpose or not. Like sometimes just forgetting, like if people would buy on credit back then more often directly with a store, right? And so you go to the general store and like get a bag of flour or whatever, and like, okay, bill me at the end of the month, and then I'll come back and settle up my bill. But like people would just forget, or like the record keeping wasn't very good. And a register solved a lot of this problems. And so he bought one of these cash registers, and like in the first year, he had $12,000 of profit that like all of a sudden showed up, right? Like, and with no change in the amount of business that was being done. So it was just like a revelation. He realized like, oh my God, this is such a game changer. I got to get into this business. So, he gets in there and gets control of NCR eventually. And the first few years they sold like basically only to grocery stores and cafes. And by 1906, when this report was written, like they're selling to all kinds of businesses, like all over the world at that point. In the 1890s, they had sales of $1.8 million. And by 1905, it was $12.6 million. So, like they 6x sales. But I mean, there's like a 14% CAGR for 15 years. Not like knock your socks off, but still like very, very consistent growth, just like every year that was better business. And at that point, they were all over the world and they were starting to expand into the Far East. Like he's talking about how he went on this trip a couple of years ago, which would have been 1904, to like China, and just saw, oh God, there's so many people here. Like it's like basically he was long civilization at that point. Like the more that civilization came about and commerce. Yeah, that is a good line, huh? And so what they were going for was the best machines, the most sales, which allowed them to have the lowest prices. So this is basically like, you've heard this scale economies shared that has been popular lately, talked about, like Amazon or some other classic examples of like just getting a big business, like Costco's the prime example. Yeah, right. Like the bigger you get, the better that you can do on the pricing, the better that, that you can lower the cost to the customer and then share some of those economies with the customer. At that point, they had 4,000 manufacturing employees, 1,400 sales reps, and they had these sales training schools all over the world that were like training up their sales staff. And it's kind of funny to see like basically like an old balance sheet of this. So they had like, a bunch of acres of land, 14,000, or I can't read my own notes here. Jesus, this is what a mess. 13 factories, 1.4 million square feet. And every year they were putting on 10 times as many patents as were expiring. So they were just like pouring money into R&D of these cash registers. What's even more amazing, they had a list of 1 million retail shopkeepers in the US and Canada. And Patterson basically invented direct mail. So he would send literature to these 1 million shopkeepers and another 600,000 in all the other foreign countries. And so he had like this customer list that early on, like no one really had this kind of like data about their potentials. And he would get, like they made the salesmen have daily reports on who they visited, what they think the probability was that they would turn into a customer, and like the number of towns that they visited per year. So they could see like, okay, is this rep spread too thin or not? Are they hitting enough of the customers? This is like all early like sales funnel stuff that like probability of sale, like all that stuff that you would see like in Salesforce
CRM,
now.
yeah.
CRM, these guys were running it in like 1906, right? And crushing it. By the way, also John Patterson invented the idea of like get a receipt with every single transaction. Like that wasn't a thing before. And so now like he's the reason for like why CVS gives us, an entire book for when you go buy a, tube of toothpaste. All right. So another thing that they had going on was they had this idea of a welfare work that they called it, which is really like early employee wellness programs. And like their factory was like one of the first ones that had like lots of glass windows so that like the light got in, and they had like showers and like an on-site doctor, like all this like almost like early Google, campus type of amenities that before anyone else had that. And they had like $3 million in labor costs in 1905, which is about 25% of revenue, which anything like 25 to 33% is kind of the what you could expect for a manufacturing facility as far as like labor concentration per dollar of revenue, labor intensity. So you'll like this one a lot. He would, and this is hilarious, they invited competitors to come to their Dayton factory and see what they were up against. Just like come watch who you're going in business to try to compete with. And basically
to scare them off.
Like he thought it was a great idea because it saved them money from like wasting money on like, you can't compete with us. Like there's no way you're going to get your costs down as low as we have. Like, look at the ship that we're running here. And, and also obviously like that allowed NCR to have like 95% market share in 1905. So, they carried a 2% dividend, and the rest was basically like reinvested into R&D and ways and manufacturing and ways to lower the cost so that they could like share those economies with their consumers. Carried no debt, no discounting ever, right? Like they had this deal where they could say, we'll pay you $100 if you can ever find anyone who is able to buy one of our registers for less than what we sell it for. And other than a 5% discount for paying cash up front. Otherwise, It was like no discounting, right? Like we have the best machines. You're not going to chisel us. Like we're never going to erode this brand by discounting it. And like so they sold these machines anywhere from $25 to $820, different sophistication levels of machine. And so I like tried to back into what that would be today. And you can only go like the CPI calculator only goes back to 1913, founding of the Fed, right? And so today those numbers adjusted would be $720 up to $23,000 basically. So it's a pretty high priced item in today's dollars, at least for a shop.
Yeah, the top end 23,000. That's expensive.
That's a fancy register, yeah. So this is why Munger, I think, liked this NCR situation so much. Not only does this thing save labor, but more importantly, it brings morality and honesty to a community because it takes away it takes away really like the temptation to steal and cheat and, cook the books basically. Like, so like this idea of bringing morality and making that sort of the default, like you could see why Munger's all about that for a society, right? Like it's totally in his, like everything that he preaches. And he talks all the time in the annual meetings about how despicable he thinks it is that when our professionals allow accounting to decay from reality and become, bastardized and politicized and, all these gross things that have kind of happened at different periods of time, like especially like the expensing of stock options when they weren't doing that. So he thought this is like the reverse of that. They would give guided tours to like 40,000 people a year that wanted to come visit their facilities and see like how this machine was running. And then a little bit, I looked a little bit further into like what happened to NCR over time because it's actually still around as a public company. And 1974, they commercialized the barcode like scanner, and the ATM as well. Like was an early sort of invention for them that they really like built out. And then they got into personal computers really early on. And then in 1991, they were acquired by AT&T, but now they're public, I guess. They must have been spun out of AT&T at some point. I don't know the details of that. I was kind of late in even realizing they were still a public company. But yeah, so that's NCR and this kind of like it's amazing to me to see all this stuff and see like there really is nothing new under the sun. Like it's all just been kind of repackaged in different way. Like I mean, these guys, Patterson's talking about how like they even paid like an efficiency wage basically at that time, like to get a higher quality cut of employee. Like they're doing all this stuff, like thinking about the wellness, like holistic, ESG-ish almost kind of like the governance side of things of, stakeholder as opposed to just shareholders. Like all that stuff was being done in 1906 as well. So lest we think that we're all geniuses today that are, summiting new heights, all that stuff's been done before. And, if we could just go back in history and look, like we could find a lot of the same stuff that people think is special today. So
a couple of good comments here. One is from Dylan Thompson. The new automated registers at Duncan go for $10,000.
I believe that.
So not that far. I guess that makes sense, doesn't it?
Yeah, you would think technology would lower the cost of the best version of something, right? Of course, it's like probably a million times more powerful, but than what the 1906 version was at for 23,000.
NCR has been cheap on occasion over the last like 10 or 15 years since I've been doing it. It's something that I've bought and sold a few times. I don't know if it's the same entity or I don't know what the relationship is, but it's point of sale. So it could be related. It's a like reasonable earner, and it just seems to, I don't know what drives it, but it gets cheap and expensive. You can have a look at the stock chart over the last.
Is it a shower, not a grower?
There's a few things like that. Actually, one of the things I want to talk about, when Buffett bid for HPQ, or he's bought a chunk of HPQ, I saw the funniest comment I saw was like after Musk bought 9% of Twitter, Buffett decided that to get his printer working, he needed to buy 11% of HPQ.
That is pretty funny.
And that's one I've held for a while, so I was happy to see
you're
a big fella coming behind me.
Dog.
And it's one of the few that sort of stayed cheap but performed the whole time. I've held it all the way. I've held it since 2019 and before, but
So is that saying that the underlying business has improved even more than price? Is that?
I wouldn't say that the business has improved so much as they've been very good at buying back. I mean, it has grown, but they've been very good at buying back stock. They've
you just have a denominator win.
Yeah, the on a per share basis it's performed, and that's what I care about.
Yeah, I thought it was funny that we got everybody's out there trying to do JPEGs on the internet and crypto and all this other stuff, and Buffett's buying actual physical printers. Oh man.
Yeah, it is funny. Like for a long time, I don't know, it was like the 90s or the early 2000s. There was like that we're going to get to a paperless office, and it was just like, this is when I was working in law firms in particular. Like they were a million miles away from a paperless office. But now I run almost an entirely paperless office. It frustrates me when I got to print something out for some reason. I got a brother, not an HPQ. I should have been loyal.
Ooh, yeah. What are you doing? You're just not taking money out of one pocket and putting it in the other.
I think I bought, but we do go to Domino's, so the DPZ to pay off the DPZs.
There you go.
At like whatever it is, like $19 a throw for a family of 5. Pretty good value.
Yeah.
The other comment that I saw that came through, and I'm sorry I missed the name, but Nintendo was founded in the 1800s. Let me see if I can find that comment. Is that right? What were they doing in the 1800s? They weren't doing like Pong or something back then.
Bicycles or something? I don't know. It's always the...
Yeah, I can't find. Sorry, whoever left that comment. I took a note, but I missed the exact. Oh, Blade. Oh, sorry. Doesn't matter. Let it get past. Yeah, I think the two things that we should talk about are, if we go into an inflationary environment, which we seem to be, like it seems to be
what was your
more than transitory.
Hint on that one?
Well, Blade, yeah. Nintendo built board games back in the 1880s.
All right.
Playing cards. Wow. That's cool. I think Nintendo's interesting. I think it's interesting now. I think it's worth taking a look at. I like Nintendo for a variety of reasons, but it's a little bit besides. So I think there's been some argument that it's transitory, right? So the reason that it's hard to pick an inflection, like a turning point in the market, right? Like if you got the turning point in 1980 or whenever the market sort of transitioned from being was the reverse of this, right? It was heavy commodities, high interest rates, and
low profit margins, low valuations.
Right, and equities were just smashed smithereens.
Backwater.
And then if you bought around that time, like the volatility through that change was massive. Like you would have felt like an idiot for on and off for 2 or 3 years there, because and that's a long time if you're trying to, you're waiting on a thesis to play out.
Feel like an idiot.
It is. I mean, I felt like an idiot for about 12 years in value, but I like you got to wonder whether that's just bloody mindedness or whether there's some rationality underneath. And I don't know which one it is, but I feel like I would change my mind if it was obviously wrong, but maybe not. But it seems to me that we're in the reverse of that 1980 type market, right, where interest rates are now low and likely rising. Profit margins are very high and likely compressing. Valuations are very high and likely compressing. So what do you do as an equity investor for the next 2 decades or 3 decades?
Wow, I think that is probably long enough to say that any of those issues of today are washed out. But 10 years time horizon, I think you have to lower your expectations considerably as to what you expect to earn as a owner of capital in business.
So what you're saying, over 20 or 30 years, it's going to be, you get back to like, you earn what the business earns, but for the next 10 years, there could be this like compression in multiples and compression in valuations. And so do you have those like figures off the top of your head? Are you know, or some like directional idea of how that, you know, like revenue growth is probably
Sure.
3 or 4%, whatever.
Yeah, I would say, well, if you look at different time periods, so I mean, we did this on the show, like, I don't know, 3 weeks ago or a month ago with Chris Broomstrand's analysis of sort of 10-year period chunks. And pretty consistently, you can count on 3% contribution of return for sales growth. You can count on a 1 to 3%, depending on the kind of price level over that time period, dividend yield. And then everything else is going to be determined by change in profit margins and change in valuations or multiples. And that's where you're kind of starting out at a
profit margins are
13% right now ish, I think, is where we're at.
What are we still saying? The average is 6, or are we saying 9, or what? Where's the average? Because that was, for a long time, that was like, you know, you've got this Buffett, Grantham, and John Hussman of all
invaluable, right? Like 6% is
right.
what capitalism will yield, or else something is broken.
Right.
And
we've been well over that for like 10 years now, probably.
Right. And that's, you know, I think large tech, returns on scale, global internet companies have defied that, what we would have thought capitalism would yield. Whether that continues is it's kind of anyone's guess, I think, at this point. And there's smart arguments, I think, on both sides. But even if you kept margins here, can you keep valuations up where they are as well? Like, call it 35 on Cape right now, right? Something like that.
We're like 5% under our all-time high.
That's pretty high. Even any regression on that, and you have to give back, 3 percentage points per year of contribution to your return that you could expect. I don't know, like that's sort of what you saw from 99 to 2009 as we worked off excess. So that basically, like, let's say you had 3% sales growth, kind of GDP-ish. You lose 3% from multiple contraction. You get another 1%-ish for 1 to 2% for a dividend yield. Profit margins, it would not shock me to see them even come back to say, like, I don't know, 10% or something, which would still be abnormally high on a really long historical data set. Well, if that's the case, and then, you lose 1 or 2% there, like, you're flat now. You're flat for a 10-year period, and it's not that hard to imagine. What's hard to imagine is which of those numbers is going to go higher to provide some kind of outsized return that would get you anything over kind of an expected 6% yield return as an equity holder. Which of those changes is going to happen from here to get you to 6%? I don't see that very easily.
Yeah. That's the problem. Everything's really stretched. All of the levers have been pulled.
The levers have been pulled, and even so the other component of that is share count. And
right.
We saw that over the last 10 years, basically a self LBO by corporate America, like lever up the balance sheet, buy back shares, reduced share count to drive up EPS to make your bonus as the management team, right? If you're linked to EPS, can you pull that lever again? Like, you're going to re-lever even further from where we are of the corporate balance sheet. Boy, that starts to get pretty tough to.
The funny thing is, I would quite
rates
like
go up.
The really undervalued stuff that I hold. I would really quite like them to do some of that stuff.
Right.
I mean, I don't necessarily need them to lever up. I just take the free cash flow and use it to buy back some stock, and do that consistently. Because when you look at companies that have done that, like, the O'Reilly and AutoZone,
right,
as like classic examples of just buyback machines, and HBQ too has been doing that. They've all got, they get nice charts, and I like the fact that there's a little bit of a floor there too. So they get bid when they fall over.
And it makes it easier that just psychologically, like every tick down, you're like, yes, buying back at a lower price for daddy. Come on.
It's anti-fragile.
Yeah, it is in a way. I mean, it makes it a little easier to stomach drawdowns when you know that
management's doing something about it.
That's the nice thing about having a good capital allocator at the helm, is that it, like, you have multiple ways to win there.
It seems pretty straightforward. It surprises me that there aren't that many companies that do it. But anyway, I saw an interesting quote from Buffett over the last week where he said, I don't know if he was necessarily predicting that the US looks like Japan in 1990, but it kind of sounded like, to me, that's what he was saying. And he said, then he was like, it's not, I think he said that it's not going to be quite that bad as Japan in 1990. But if it is, like, the setup for guys like us, like the deeper value guys, that's usually pretty good for us. Or it worked pretty well for us. Low valuations work okay, particularly if you can find something that's buying back stock.
Yeah, I mean, you had a great paper back in 2009, I think, on Japan, and that value worked actually quite well. And there were multiple cycles within a malaise period of however long it's been for Japan, where things did get cheaper and more expensive. Especially, I think the dispersions blew out at different points, but it was kind of masked with a kind of quiet average. So no one really was paying attention to what was happening under the hood. And if you were buying at those time periods, like, I think you actually did quite well, even with kind of going nowhere as an index.
The paper that I had up is just buying on price to earnings, price to book, price to cash flow. And then there's some weird ones in there. It's like an academic paper where some of them were, they were looking at, there's a few weird metrics in there. They're not really growth metrics. They're just, but anyway, those metrics don't work. So I don't really pay too much attention to them. But yeah, so John Battle's got a good question. Was Japan the global reserve currency in the 1990s? No. And I don't know. There's clear, like, this is why macro is so hard, right? There are like any number of differences between Japan and the US. And the other one is that Japan had all of those cross shareholdings, so there could be no activism, so nobody could take those undervalued companies and take them over. And, yeah, none of that could happen. And so it had to work its way off in a different way. Whereas if that happened, if everything gets really cheap in the States, it won't stay really cheap for long, because there's so many guys who are activists or LBO or operator types who'll go in there and tear it up. So I don't think that Japan is a particularly good proxy, but there's enough value investors here that at least if it got cheap enough, there'd be a bid for those things if they went down. I don't know.
And I mean, I think the analogy breaks down some too with, I mean, the US is just a much more dynamic economy. And you could make the argument we were even more dynamic when we allowed failure and allowed the changing of ownership of businesses to hands that might have been better stewards of that capital. I think when we block that, I think we do look more like Japan then, and we do start to become more of a sclerotic and less dynamic. So
does that happen?
I think the US can find its roots again in that. And
what makes you think that doesn't happen in the States?
I think we have maybe like better bankruptcy laws for one thing. I think a lot of it's cultural too. Like
but what makes you think that hasn't happened recently? Like, what's the recent change versus the way it used to be?
I think just cheap debt and has allowed a lot of companies that probably should have gone under to still keep existing. And kind of quote unquote zombie companies that are their earnings are less than interest expense, so they're just accruing more debt to stay alive. That I don't think that's healthy for capitalism. I think that's much more akin to like a cancer and probably needs to be extricated.
Yeah, those low rates can't stay. I mean, it just seems like the rates are going up.
Well, I mean, who knows? I would have said that quite a while ago, but
like we've been talking about, mortgage rates have gone up. That's
been wild, hasn't it?
Mortgage rates are going vertical. Mortgage rates haven't gone up this fast, like in the data, something like that. And now we're at like
5% a day or so, like on some days, like just absolutely insane.
It doesn't seem to have done much to have cooled the market though.
Yeah, that's the thing about macro that's really hard, is there's so many moving, like if there's no inventory, then like, okay, well, of course it's still going to stay hot, right? I guess. maybe everyone's just trying to get in before the rates get so high that they want to lock in that mortgage today as soon as they can. I don't know. Like there's lots of macro's hard.
There's a question here. Am I long Australia? Australia's like Canada in the sense that there's a big basic materials component to it, which is second to like the financials. The banks and financials is the biggest component. In Australia, it's like half the index.
Really?
And then like a third to 20%, I think, is basic materials. And then like everything else.
What are the big banks in Australia? Like
there's 4 big banks. There's 4 big like commercial banks. Commonwealth, National Australia, ANZ, and ANZ as we call it in Australia. And I'm blanking on the 4th one.
I've never even heard of any of these. So
they're giant banks. Like that. This is the thing. They're very, very big. They like to go overseas and make an acquisition every now and again and just write off the entire acquisition. They're not very good at buying overseas. Because in Australia, like there's this idea that they protect the 4 big banks. The government protects the 4 big banks. So there's no competition, though it's hard to compete, but they never go out of business either. So they're kind of like regulated utilities.
Okay.
But I've done like every now and again, someone does an analysis of it because it's been so long since there's been a recession in Australia. Someone does some analysis. Westpac, thank you very much. Someone does an analysis where they say if you take like the last time there was a recession in Australia and you look at the damage to commercial credits and housing credits, and then you translate that forward to today, to the leverage that they've got in their banks, like a lot of these banks are wiped out. Yeah. I just don't think it's going to happen like that. Like I personally had that view about 15 years ago. Like that's how long it's been.
Yeah.
It's just been rolling on, keeps on rolling on. I don't think it'll be that bad, but who knows?
They've got to have a lot of China exposure, right? Isn't that a pretty common thing for Australian companies, especially the commodity based?
Yeah, but the commodities are all smashed to pieces already.
Yeah, okay.
I mean, if you like, that's so. I know we get some criticism for talking macro all the time rather than
Sorry, guys.
than individual names. But here's the problem, right? Like if I look in my screen, all of the stuff that's super, super cheap right now, it's all commodities, heavy commodities like BHP, Rio, all those kind of names are in the screens. And I don't know, it's just, I got a lot of scar tissue on me for owning a lot of that stuff. It's hard to go back in and buy a lot of that stuff. But then that's probably the way everybody else feels too.
Yeah.
Yeah.
That's how you get a mispriced bet.
I'd rather buy it now than 10 years ago, but I did buy it 10 years ago. So
what kind of ROEs did the big banks down there get? Do you have any idea? You said they're pretty levered, so maybe it is kind of high.
I don't know. I would say close to 20%.
I've been shocked to look at some banks and see what the ROEs are over time. Like they're just way higher than I would have ever imagined for something that seems so commodified, which providing money, right?
I don't know what does it, like low rates. And like, well, you can,
debt.
you know, your credit card's at like what, 25%, and your savings account's at 0.1.
Yeah, that's not a bad spread if you can get people into that labyrinth.
I guess that's part of the problem. Aussie, Canada, USA commodities need a re-rate versus less appealing jurisdictions. Yeah, I like it'll be. I don't know what the answer is to the macro picture, but it probably is worth having some of those.
I don't even know what the questions are. I don't, more or less the answers.
That's fair. Yeah, I might be in that boat too. I might be overestimating how much I understand here. Yeah, macro is part of the equation. That's kind of what I think too. Like maybe the answer is you shouldn't be in stuff where macro is part of the equation. Like I don't really like energy for that reason. It's just there's one number that you got to get right. Although probably when it went negative, that was a pretty good sign that you should own a bit more energy.
Yeah, that's a good point. I'm reminded. I bet we will see this again. Which I don't know if you remember this, but like in 2010. There was everybody I think a lot of value guys, especially too, but like they all said like, yeah, you know what? We probably ignored the macro too much. We were just like, oh, we're just bottoms up stock pickers. I don't know if you remember, like, I think even Einhorn was saying that at that point.
Yeah. Later too. I would say 2015, 16.
And I'm going to guess that that's a cyclical thing as well, where we're going to hear that same story again. And in like 2 or 3 years, there'll be a lot of guys who said like, and maybe it'll be the growth guys this time, like SaaS bros who are like, yeah, we probably should have thought about the macro a little bit more.
It's hard to know. Like Buffett says, ignore it, but then Buffett's clearly.
But then he'll rattle off like 1,000 numbers of different, like,
right.
Oh, the GDP of Swaziland, in 1987.
And then he'll go and have a swing at silver, like just
right.
as a, or that the Chinese oil company, CNOOC. What was that?
PetroChina.
PetroChina. Canada rate hike is tomorrow. Market is expecting a 0.5% increase. Neutral rate might go to 2.5 to 3%. We're at 0.5% now. Yeah. We're sitting well below. Yeah, the neutral rate. We're sitting well below the neutral rate. That's what I think too.
What does that mean? You mean like some natural rate of interest?
I think so. Something like that. Yeah.
I mean, what the hell does that even mean, though? How do you know what the?
Well, you don't unless you let the market go and find out.
Well, we're not
Nobody knows it. That's the point, except for Jay Powell. He knows.
Okay.
And all the PhDs at
Rudy Havenstein knows what the NIRU is.
I think that Rudy's probably got a better idea than anybody else does.
Well, he's been around for 200 years now, right? So when was he born, in the 1860s or something?
Hit us up with some questions, then. Oil is the natural rate. Yeah, I like that one.
That might be some truth to that, huh?
Yeah, oil spiking. Oil might do the job that the Fed's not doing. Oil might be doing that job.
I've heard that said before, that the price of oil is a version of federal funds rate. Do you think, though, that so I've thought about this before about the energy intensity of an economy, and I've tried to look this up before. And, if you're going to more intangibles, and part of that is sort of saying, like, at the end of the day, like, we're all just sort of fighting entropy, right? Like, we're trying to put in energy into a system. And I mean energy in a lot of different ways, not just physical energy or the sunshine, hitting Earth to provide all the energy that fights entropy on Earth.
Chi. You mean chi.
Yes, right. So if we are all really at the end of the day just like sort of rearranging things to make them more productive than they would be in the natural decay of entropy, it can be in the form of information. We're rearranging information. It can be in the form of molecules that we're moving around that are more useful to us. The moving molecules around, the atoms of the world requires energy. And so if your economy is more based on moving molecules around, then you're going to then have a higher energy intensity. And therefore, probably that oil as a federal funds rate makes more sense for that. But if you're largely intangibles in your economy, which, we're over half of the investment in our economy is in intangibles now and not in physical CapEx. Maybe energy intensity, like, it makes it maybe less of a relevance to it. I don't know. Like, it's just something I'd sit around and daydream about.
I like that idea, but the Bitcoin miners pretty energy intensive, aren't they?
No, I said useful energy usage.
Is that a product of us just being so? We're right at the very top of that tail of that chain of like intellectual property, where you push down all of the stuff that's easier to do, which tends to be the manufacturing stuff, which is why that gets offshore
in other countries. Yeah.
And you own the IP and the know-how here, and the distribution is coordinated from here at least. But that's still a cost that factors in somehow, and you have to feed everybody here. You have to get stuff around here. Those costs are still real.
Yeah, and I mean, I think that's the best argument to me against deflation in the next 5 years, is that if we have to reconfigure a supply chain that doesn't include as much of the productive capacity of the rest of the world, it's just going to be more expensive for everything.
Yeah, China's on the going to be on the wrong side of that divide for us anyway.
Well, I hope not, for everyone's sake. Yeah. I mean, I think the less advantaged you are, the worse this is going to hurt too, which is the real bitch of all this stuff, is that, Powell's not missing a meal. He doesn't give two shits about, how much a banana costs.
He's $100 million man.
No. And
how much can a banana cost? Like $15, $25?
Yeah, exactly.
Just get 6.
Right.
Yeah.
So if that's the case, like it's going to hurt the people who can afford it the least to be hurt. And that really is bothersome to me.
Well, we've talked about this before, filling up the gas tank in the car. Like I do that cartoon thing where the eyes pop out of my head every time I pay for it.
Yeah, no
but
doubt.
I do have the luxury of not having to worry about it that much.
But you don't fill it up by half of a tank because you're
right.
like, well, I don't know where I'm going to get the money for the other half of the tank, right?
Right.
That's some people's daily existence.
That's what I'm saying. I've got that luxury, but there are lots of other, like if you divide the cost to fill up the tank by the hourly wage, it gets scary.
Yeah.
And rent too, like rent's got to normalize to
maybe worse there.
Yeah. It's got to normalize to housing prices, or housing prices have to come back, or a bit of both. And I think that's what's happening this year. That I don't think there's been any slowdown in housing prices, or not that I've seen. Maybe there is, but the whatever they call it, the rent's going up like 20-25% too.
The rent's too damn high.
The rent is too damn high.
I had it right all along. How did he not win?
It's a great slogan too. It's easy to remember. Sticks in the mind. Yeah. How did he not win? Just shows that it's rigged.
It's rigged.
Need a recount. Yeah, real wages aren't up. They're not up that much. I don't know if they're up much at all. That's a funny thing. Like you get a 6% bump, and you just like your purchasing power's gone down 2% over the course of the year.
That's the official number.
Yeah. Rent prices have doubled in the last few years. Yeah.
Oof.
The reshoring of productive capacity is the foundation of the idea that Oz, Canada, US natural resources need to re-rate. Safety of supply is the new most valuable thing. Yeah, that's kind of interesting.
Yeah. Well, just even imagine how much more expensive it's going to be when they want to just add more inventory to the whole system, right? Like just in time, we realized was like a little just too close to the edge. Even just the working capital to create all the inventory that will allow us to run the supply chain might take 2% out of profit margin, like in the next 10 years. Like I could believe that.
Yeah, that's optimistic probably. Real wages flat since about 2000. Yeah, I think that's right. I think the last time I looked, it was like the peak was the peak of
like 1970 or something, wasn't it? I mean,
no. It was 2000. It was like Bill Clinton. 2000 was the peak of real wages, and then it's been down since then.
Well,
it certainly feels like it.
We almost need a technological Hail Mary to connect somewhere to like just make all this stuff
fusion.
Move. Yeah, fusion or 3D printing, like something breaks through that we just like, oh, okay, never mind. Like the pool of goods and services has gotten so big now that it doesn't matter that we have all these other problems. It's all solved now.
Fusion's the answer, right? Fusion means, as you've pointed out to me, unlimited clean drinking water. That solves a lot of problems.
Food. Yeah.
Electric cars.
Cheap energy is a prime mover that solves many, many issues. It's probably nuclear might be the even better answer there, but
that'd be a good first step. Get some money in there, get some technology in there.
Imagine 1950s when we were working on this, and it was they were talking about how energy's so abundant and it's so cheap that it wouldn't even make sense to meter it. It's too cheap to even meter. It doesn't make it's just use it as much as you want.
That'd be great.
Like breathing air.
And on that note, we've done it, JT. We made it.
Woo! I need a break. I'm gonna go lay down for a while.
Yeah, Black Death. Thanks. That's Black Death also increased real wages in the 1300s.
That's not the denominator that you want to shrink.
until the king declared that it was illegal for people to move farms or to have or to ask for higher rates. So everybody had to go back to their farms and get paid the same rates, even though there were many fewer of them.
Oof.
That's tough.
Don't do that.
Thanks, Amiga.